Shanghai Hong Kong Stock Connect now opens China's stock market to international investors for the first time without receiving prior approval from the government. And Chinese investors will have access to Hong Kong listed securities for the first time as well. So how significant is this development? Well, to answer that, from Hong Kong, we're joined by Yonghao. He's the Regional Chief Investment Officer at Northern APAC of UBS Wealth Management. And from Chicago, we've got Jonathan Brodsky, Managing Director at Advisor Research. And welcome, gentlemen. Good to have you on the show. Yonghao, I'm going to start with you. Today, the first day of trading in both directions, Hong Kong's daily $2.1 billion quota for mainland China shares was filled by mid-afternoon. Southbound trades only utilized about 17% of this daily quota. Why is Shanghai getting so much more interest from Hong Kong investors and not the other way around?
Well, I think it's largely due to existing investors' position. I think if you look at the lot of the investor already has been properly positioned in the Hong Kong, so they already had some access to the Hong Kong market. But to the northbound, let's say the overseas investor to access Chinese market, in a way the access are still very limited. And that's why we see the stronger interest to the northbound, but not the weaker interest in the southbound investment.
And Jonathan, I'm going to bring you in from Chicago. Do you expect that to change at any time? Do you expect to see a reversal in that trend?
I think the northbound trades will continue to be strong. You know, we're foreign investors located in Chicago, and we've been waiting eagerly for the opportunity to trade in Shanghai. So the Connect is a big development for us. I think a lot of Chinese mainland investors have had the opportunity, if they're established investors, to trade in Hong Kong one way or the other. But for us, without a QFII license, this really is a major development, which gives us an opportunity that we didn't have prior to today.
It's certainly a major development. And Yonghao, I want to ask you, how does this now help bolster Shanghai as an international financial center like London or like New York? And is this one of the goals for this Stock Connect?
Certainly, I think it's in the country's mind that to push Shanghai become one of the major international financial center. That's their ambition. Obviously, this kind of opening up, have more mutual market access, help Shanghai to moving towards that direction. But nevertheless, if you compare with the, let's say, New York or Chicago or London, I think Shanghai is still just starting. I think you can name yourself as an international center, but whether or not you are really a truly international center, it doesn't depend on your definition. It's more depends on the external users, whether or not they treat you as an international center, whether or not you have a fundamental support, such as legal, environmental, and other IT, and so on and so forth. So to me, this kind of the mutual market, mutual access help Shanghai moving towards that direction, but it's still a long way to go to become a truly international financial center for Shanghai.
It is certainly a step in the right move, and one of the problems has been trading restrictions, because Jonathan, if you keep in mind that China is the world's second largest economy, its weighting in major regional and global indices has been so much lower than its economic contribution to the global economy. Do you expect that to perhaps change with this exchange, and how so?
Yeah, I think the opening up of the trading opportunities is a big step for a re-rating as it relates to the indices. As you've mentioned, China is a very low weight in the global indices precisely because of lack of access to those markets. There are other issues to overcome, but as the market liberalizes, we would expect China to carry a higher weight in the indexes, thereby bringing in more capital.
What are some of the cons of this? Are there any losers in this deal? Jonathan.
I think the potential losers here are some of the large investment banks which have made quite a bit of money off of the QFII trading situation, costs associated with that. The liberalization of these markets is good for retail investors. It's good for institutional investors. I think the potential loser here really is some banks that made high levels of fees trading off the old regime.
Well, Japan Exchange Group has expressed interest in joining the Hong Kong-Shanghai Connect. Yonghao, do you see other exchanges trying to get in on this party as well?
Oh, certainly. I think China have clearly there are other things on the map in the pipeline. I think Shenzhen might join the market mutual access, and I'm sure this kind of through train will extend to the other stock exchange. I wouldn't name particularly one, but I think China is gradually integrate into the world in the financial sense or economic sense. I like to say that China's integration to the global economy bring a lot of investment opportunities to everyone. I think banks probably will also benefit from a big pile. Even some of the business may be going to see in a way it's going to reduce. But then the China's integration to the global economic environment, particularly financial world, will increase the opportunity for the banks. Yes?
And Yonghao, I want to stay with you. What about the role that this could play for bolstering the renminbi in the global stage?
Yeah, I think renminbi, again, this is probably one of the reasons why Chinese financial market hasn't fully integrated into the world financial market, because currency is not fully convertible. I think China is moving towards that direction. Hopefully, renminbi will gradually become a convertible currency. Right now, China is still concerned if you allow the renminbi to be fully convertible, basically you open your monetary policy. So that's why China was only slowly making progress in terms of pushing the offshore renminbi center and so on and so forth. And you still can see that the progress is very incremental or gradual, because even, let's say, with this kind of market neutral access, you might see Chinese citizen can invest in the Hong Kong listed stock. Sounds like the capital has been flowing out of China, but effectively when they liquidate this kind of position, the money will back to the China in the renminbi term. So in a way, this kind of capital outflow has been is kind of in a very controlled fashion, is not fully a flow yet.
All right, we're going to have to leave it there. We're out of time. Thank you so much. Yonghao Pu, Regional Chief Investment Officer of Northern APAC at UBS Wealth Management, and Jonathan Brodsky, Managing Director at Advisory Research.